Understanding the market cycle can seriously boost your investment game, whether you're in stocks, gold, crypto, or other assets. Hey, it's John from StopSaving.com here, and in this guide, I'll explain the 4 market cycle stages and the 13 investor emotions that typically go with them, according to the Wall Street cheat sheets psychology of a market cycle. You'll also get a blueprint for how to invest or not invest within each market cycle stage. So let's explore how the market cycle drives investor behavior and asset prices and what you can do about it. Now, a typical market cycle for any investment has 4 main stages: accumulation, where prices base; markup, where prices race; distribution, where prices stall; and then the markdown, where prices fall. If you've watched our video on the Wyckoff method, you'll be familiar with these stages from the perspective of big investors or whales and how they control the markets. I'll leave a link to that video in the description if you're interested. But getting back to this video, we'll cover each stage from a slightly different angle, using real examples to explain them. We'll use price charts for stocks, the US dollar index, treasury bonds, and my personal favorite, Bitcoin. So let's get started with the first market cycle stage, which is accumulation. This stage happens as the market bottoms out and smart money investors start buying or accumulating investments at lower prices. Market sentiment is generally negative here, but prices begin to trade sideways as the downtrend loses steam. This stage can last for a few months or many years, depending on the severity of the bear market before it. This chart shows how the last accumulation stage for US stocks, or the S&P 500, took about 9 months from July of 2022 to March of 2023. The bear market before this accumulation stage was relatively short, 40 weeks from top to bottom, with the S&P 500 down only 27.5%. Note that the accumulation stage started before the index bottomed. The smart money began buying stocks at what they perceived to be good value before the actual low. Notice in the charts how the price made slightly lower lows while the relative strength index in blue made slightly higher lows. That signaled bullish divergence, a sign that buying pressure was getting stronger and accumulation was underway. Now, if you'd like to learn more about the RSI and bullish divergence, check out this RSI guide here. I'll leave a link to it in the description. The Wall Street cheat sheet psychology of a market cycle lists 13 emotions that investors experience during a typical market cycle. In the accumulation stage, anger and depression are the name of the game. First, investors get angry because they're down on their investments. Then they get depressed because the market takes forever to recover. But as investing legend Sir John Templeton would say, the time of maximum pessimism is the best time to buy. As for how to invest during the accumulation phase, you want to follow the smart money and accumulate investments at a discount. But remember, accumulation stages can take a long time to play out. So your best bet is usually to build positions slowly by dollar cost averaging, i.e. investing smaller amounts at set intervals. Look for quick downward moves during the accumulation stage and buy near the bottom of the trading range. You'll also want to check for bullish divergences between the RSI and the price. Remember that this can signal an increase in buying pressure, even though prices might still be trending lower. Sorry to interrupt, but I've got a quick offer before we go on. This video is brought to you in partnership with StreetBeat. StreetBeat is your own AI-powered investment advisor in your back pocket. The StreetBeat app lets you ask AI about the market, and it can even create your own investment portfolio tailored specifically to your circumstances and risk tolerance. StreetBeat also offers lifetime credits for up to 25% off tuition fees for over 450 universities for you or your family members. You can access that deal and more through our deals page at stopsaving.com/deals. When you support our partners, you help grow our channel while getting good deals for yourself in the process. So thanks for that. I'll leave a link to our deals page in the description. And now let's get back to the video. Now let's move to market cycle stage number 2. The markup. The markup stage follows accumulation and involves rising prices and increasing investor interest. The price chart makes higher highs and higher lows, forming an uptrend. Whenever the price drops, investors step in to buy the dip, getting greedier as the markup stage goes on. Momentum traders and latecomers who were initially skeptical also jump in, driving prices higher at a faster rate. And that's why you'll often see the biggest price gains in the final innings of the markup stage. This chart shows a recent example of a markup stage for the US dollar index, or DXY, which rallied 28.7% from bottom to top in just under 2 years. Notice how the markup started slowly before picking up pace near the end. Also see how the 20-week moving average of the DXY sloped upward and supported the price for most of the rally. The DXY finally peaked when the trade was very popular and not when investors shunned it. The markup stage of the market cycle usually has a wide range of investor emotions. In terms of the Wall Street cheat sheet, it tends to start with disbelief, as investors have become accustomed to prices going sideways or down, so they're skeptical of the initial turnaround. But as the uptrend builds, hope kicks in and they start believing in a possible recovery. Next comes optimism, where they invest more, and then belief as the market booms higher and they get fully invested. That turns into thrill as more people buy on margin, i.e. borrowed money, and prices start to peak. During the markup stage, you typically want to hold investments and avoid selling too early. The trend is your friend after all. That said, it's important to stay disciplined and not get carried away by the excitement. If you're going to buy an investment in the markup stage, consider buying the dips and not the rips. This way you can get a relative margin of safety with your investments. You'll also want to monitor moving averages to gauge whether the trend is still your friend. Make sure to check out our moving averages guide if you'd like to learn more about that, and I'll leave a link to that in the description. Now moving on to market cycle stage number 3, and that's distribution. The distribution stage is when the smart money, who likely bought in the accumulation stage, starts selling their positions. These investors are already sitting in substantial profits, and they're cautious about the market's froth and irrational exuberance. Distribution stages can often take a while as the market forms a topping pattern, like an M pattern or a head and shoulders pattern. You might also see bearish topping candles with high trading volume as smart investors sell to the often over-leveraged latecomers. See the iShares 20-year plus Treasury Bond ETF TLT in this chart. It rallied 60% over 70 weeks, but in March 2020, as the pandemic rattled markets, TLT had a major blow-off top. The price then took about a year to form an M pattern, which became part of an even bigger head and shoulders pattern between mid-2019 and early 2022. There was also bearish divergence between the price and the relative strength index, a sign that selling or distribution pressure was strengthening despite rising prices. The distribution stage usually starts with euphoria among investors, where leverage, margin, and speculation are peaking along with the investment's price. That's usually when the first big wave of sell orders comes in, pushing the price down to drown the late buyers. Since many investors still have their buy the dip hats on from the markup stage, the buyers fight back, believing that prices will recover and the good times will continue. Investors then become complacent as prices stall and volatility cools off. During the distribution phase, you typically want to avoid buying on margin. If you're already in profits and bought the investment early, consider selling a good chunk of your position. If you haven't bought the investment yet, it's usually best to stay out of it and look for another asset that's in a clear accumulation stage instead. You might also consider shorting the investment, but just be aware of the risks and make sure to use a stop loss in case the market rips higher instead. Last but not least, there's the markdown stage. The markdown stage happens when prices begin to drop as selling pressure rises. Investor sentiment turns negative, leading to more selling and so on. This causes the price chart to trend down with lower lows and lower highs. When the market bounces, investors tend to sell or short the rip. This stage continues until excess leverage and speculation are flushed out of the market and prices begin to bottom out again, i.e. until the next accumulation stage. As you can see in this chart, Bitcoin tends to have incredible bull markets followed by vicious bear markets after each distribution stage. After Bitcoin's 2021 peak, for example, it crashed 77.5% over 54 weeks. Notice how Bitcoin's 20-week moving average was sloping down most of that time, often acting as a ceiling on its price. The accumulation stage after the markdown coincided with the flattening of that moving average. The markdown stage usually begins with investor anxiety, as the dip turns into something worse. Leveraged investors often get margin called, forcing them to close their positions, which triggers even more selling. Then comes denial, as prices keep dropping, which eventually turns into panic. The market often ends with capitulation as investors give up and sell their investments at the worst possible time. That leaves them with anger as they lost so much money. As for investing during the markdown phase, well, you don't. When prices are falling, the temptation is to always buy the dip. But what if the dip keeps on dipping? Instead of trying to catch a falling knife, it's usually better to stay out of the market during the markdown. Instead, wait for clear signs that the accumulation stage has started before buying. Like it or not, markets are designed to extract money from emotional investors. So the key is to not invest based on your emotions. That said, it's crucial to still keep track of your emotions when investing, because if you feel a certain way about the markets, chances are that others do too. That knowledge can help you determine the most likely stage of the market cycle so you can act accordingly. So that's it for this video. As usual, none of this is investment advice, but if you found value in this content, remember to subscribe to the channel and click the notification bell to get these videos as soon as I publish them. And don't forget to like the video if you did. This helps our content to reach more people on YouTube. You can also find a more detailed written version of this video on our website, stopsaving.com, where you can access the PDF slide deck I used for this video. Link in the description. So thanks for watching and take care.